All right. Welcome back to Principles of Accounting 2, where we've made it to the third week already. And, I was just saying that it feels like time goes by a lot faster as you get older. And that's how I feel today for some reason. It just feels like we're just moving by fast. So appreciate all of you. I wanted to just quickly say that I really appreciate the efforts that all of you have made during these first 2 weeks of the class. That LinkedIn Learning Certificate that you completed in week one. Appreciate that. I know that some of you struggled with getting the account activated and navigating how to find it, where to watch, all that jazz. So just want to say thanks. I appreciate the patience. I appreciate you working through it. And if you haven't done it yet, I don't know what to tell you. You need to get it done. Okay, so most of you have done it. A few of you I'm still waiting on for some reason. You know who you are. Get it done. Okay. If you need help, reach out to me. Let me know you need help so I can help you. All right. The reason why I'm bringing that up now is because here we are in week 3, and I don't know if you've been seeing what's going on, but week 3 is a little bit lighter. So we just have the chapter 18 quiz for this week, which is great. Because it gives you time to make sure that everything else is done. So, the other reason I wanted to call your attention to the classroom is because I created something for you. I have a gift for you. Okay. And this is specific only to this class, meaning only the people taking this class right now have access to this. I built an entire AI model just for you, just for this class. This took me months to finish. I did a lot of coding using Python. I created guidelines and barriers and a lot of uh, boundaries for this AI model. This AI model is trained only on this course's content. It is designed to act as a tutor for you for this course. Okay. I want you to think of this AI model as a virtual tutor for you. Okay. For this course. So here's how it works. It's a very simple model. It's a very simple model. The way that it works is you'll open up this link. It says Dr. B's Managerial Accounting ChatGPT Tutor. I built this AI model just for you for this course. You'll open it up. It'll first look like this. It'll ask you to either sign in to ChatGPT if you have an account already. Otherwise, you can create a free account. This is entirely free, nothing paid. This is a resource that I built for you. Okay. So you just log in or sign up if you haven't signed up already. Once you get into the model, it'll look like this. Let me open it up in a new tab. It'll look like this. This is your managerial accounting tutor GPT AI model that I built specifically for you for this course. It's designed to be a tutor. Okay. So if you have questions about some of the content that we're covering, and you're like, oh, I think I remember, but I'm not sure, it's a real quick type of question, type it in here. Ask it. Okay. Ask it stuff about managerial accounting. You could be like, something like, what is job order costing? Something simple like that. All right. And you'll see it'll give you a response. Here's the definition of it. Here are the components that go into job order costing. Here's the cost flow, what it's used for. conceptual ideas, and then it'll ask you prompting questions. Just answer the questions, and that will bring you deeper into that content, right? It's designed to be a tutor. So it'll ask you questions, you'll ask it questions, and you'll learn from it. That's what a tutor does, right? So basically, what I've built here for you is a digital tutor. And it's right here in the classroom. You access it right here through the classroom, and it's super, super easy. Okay. So that's it. My gift to you. It took me months to build it. So please use it, experiment with it, give it some time, right? Play with it a little bit, okay? And let me know what you think. I want your feedback. Your feedback helps me to improve these types of things that I'm doing as I'm teaching courses like this. My goal is to make your life easier and to provide you with as much content as I possibly can in a meaningful way. And so that's why I built this tutor for you. I want this to be something that will help you as you navigate managerial accounting. So just know that that's in the classroom for you. Please use it, play with it, and give me feedback when you can. So it really helps. Anyway, that's my thing on AI that I've built for you. Okay, it's an AI model I built for you. So please use it. It's right here, right in the classroom, just below Ask the Instructor. There's your tutor. Okay. Anyway, so we've made it all the way to week 3. And in this week, I'm going to introduce you to managerial accounting concepts. We're going to talk about what you're to expect as we talk about things like cost, the cost of producing a product, the cost of manufacturing, the cost of running business, right? We're going to talk about those things throughout this course. And so I'm going to provide you with a foundation of what this course is all about and what to expect to learn about over the next, remaining 12 weeks. So let's jump into our managerial accounting concepts. All right. So I'm going to talk very briefly about managerial accounting roles and the ethics. I'm going to talk about cost. I want you to get into the mindset of a manufacturer. I want you to think about the manufacturing process, what's involved in making things. I want you to get to that type of mindset. So that way, the next time that you go to the store and you purchase a product, you're going to know how much it actually cost them to make it and what that process was like. And it'll give you a new appreciation for that product. Okay. Um, so that's what this course is all about. This course is all about, and it helps you as a manager to understand all of the different costs that go into making a product or providing a service, and then how to manage those costs. Right? That's what this is all about. So I'm going to explain to you the different types of costs, the classifications of those costs, the cost flows, trends in management accounting, and I'll also give you a couple ratios, all that fun stuff. So, first, I want to talk about what managerial accounting actually is. Managerial accounting, textbook definition, provides financial and non-financial information to uh, financial and non-financial information to an organization's managers. Managers include employees in charge of the company's departments and divisions, heads of marketing, heads of IT, the heads of human resources, top level management like the CEO, CFO, CIO, COO, We provide these managers with financial and non-financial information to help them to make decisions and to drive the company forward. That is what managerial accounting is. That's what this course is all about. The purpose of management accounting or managerial accounting is to provide these managers that we just talked about, to provide them with planning and controlling strategies for the business. The purpose of management accounting is to provide useful information in determining the costs of the organization's products and services, plan for future activities, and compare the actual results, financial and non-financial, to the planned results, also known as the budget. Planning is the process of setting goals and making plans to achieve those goals. Very simple, right? We use what in business we have what we call a strategic plan, also known as a 5-year plan, maybe a 10-year plan. These are typically long-term plans that is set by management and are strategic in nature to help them to achieve goals, right? Whatever the goals are, both short-term and long-term goals. So that's what the plan is. We then need to, as managers, control that plan based off of what's happening, the actual results. Control is a process of monitoring and evaluating the organization's activities and their employees. The feedback from the control function helps the managers to identify and compare the actual results to the budgeted amounts. We can then take corrective action based off of those results. So, for example, if I go over on some of my costs or expenses based off the actual performance, I compare that to the budgeted amount. If it's over, if my costs are over than what I had planned on, as a manager, I can then go back and control those costs in the future. So that way I don't make the same mistakes or the same type of cost overruns again. Right? This is the purpose of managerial accounting. So who uses managerial accounting information? Managerial accounting information is used by the managers of the company, people inside the company. That's who cares about managerial accounting information. People inside the company. This is in comparison to financial accounting information. And financial accounting, which was what we learned about in Principles of Accounting 1, we were concerned about things like the income statement, the balance sheet, the statement of cash flows, the statement of retained earnings. All of those financial statements are published and available to external users, the banks for lending decisions, stockholders for investing decisions, the government for tax decisions, and of course, managers as well. All of those people care about the financial reports, the income statement, balance sheet, statement of cash flow, statement of retained earnings. They care about it. Those reports are structured by generally accepted accounting principles. They're auditable. They're based off of historical data. They focus on the whole company. They're monetary in nature. Income statement, balance sheet, statement of cash flow, statement of retained earnings. That's what we learned about in Principles of Accounting 1, financial accounting. Okay. Managerial accounting, which is what this course focuses on, We look at the internal components of the company. We focus a lot on managerial decisions, management making executive decisions to help guide and run the company, to plan and control. House managers to plan and control. The reports that get generated internally, like the budget or the statement of the cost of goods manufactured, these are internal documents. They're reports used for management's purposes only. Therefore, we do not make them publicly available. It's only for the managers to make decisions. That's what managerial accounting is focusing on. So, from that perspective, we don't have to follow generally accepted accounting principles for our reports. They're not going to be audited. They're only used for management's ability to make decisions. Okay. So that's the difference between financial accounting and managerial accounting. This course focuses on the managerial accounting side of things. Okay. It's still important, regardless of whether it's financial accounting or managerial accounting, to be ethical, to uphold ethical standards. That is the cornerstone of everything we do in business. We must act ethically. And with respect to accounting, we need to be able to understand that fraud is something that occurs in business. And we have to be able to monitor and control fraud as much as possible. And wherever possible, try to prevent fraud from occurring in the first place. Now, the thing with fraud is that it happens. Okay, it's unfortunate part of business. We as managers need to be able to identify when fraud has a possibility of happening, why it happens, and figure out ways that we can mitigate or reduce the risk of fraud from occurring. It's impossible for us to prevent fraud, but we can at least mitigate the risk of fraud. The ways that we do that is by understanding why fraud happens in the first place. And there is this thing called the fraud triangle that was created for us to be able to understand the pressures of fraud, or the three parts that cause fraud, or the opportunity to commit fraud. Uh, the fraud triangle says that there are opportunities, pressures, and realizations of fraud to occur. The opportunity is there's an opportunity for someone to commit fraud, right? They have a low risk of getting caught, therefore, there's an opportunity for them to commit fraud. There are pressures or incentives to commit fraud. Person feels like they're pressured at home, they might have an incentive to commit fraud. These pressures could be like personal financial pressures. Oh, I'm having trouble paying my bills at home. The company has the money. They have I can just, take some, not a big deal. That's pressure, right? And then we have rationalization, or the attitude of the person. The person justifies committing the fraud and doesn't see this as being a crime. It's rationalization, right? Oh, everyone does it. Oh, it's not a big deal. That's rationalizing things. Right? So the key to stopping the fraud from happening is preventing the fraud. Now we know that it's impossible to stop it from happening, but we can at least mitigate the risk of it happening. We can also find ways to detect fraud when it does occur. We do this through internal control processes. Uh, Ethics is at the core of everything that we do. It helps us to distinguish right from wrong. The Institute of Management Accountants, which I belong to. I'm a member of the Institute of Management Accountants. I am a leader in the Institute of Management Accountants, and they have developed an ethical framework that we work within. Um, and it requires that management accountants are competent, we are confidential with our information for that we have with the company, we act with integrity, and that we communicate information in a fair and credible manner. Okay, so this is the importance that I'm trying to say is that we must identify fraud, we must prevent it, we must mitigate the risk, and we must identify what causes it to happen in the first place. So, therefore, as managers, we have the ability to prevent it from happening in the first place. I next want to talk about the different areas of accounting that you may not know exist. Accounting is not just, someone in an office somewhere that's just jamming numbers in. That's not what accountants really do. Accountants go well beyond that. And in fact, accountants are seen as partners to managers. They help managers to see the insights of the business, okay, to help them to drive the business forward. Even marketing uses accounting information to help them to make decisions on what products to promote. Management obviously needs accounting information to help them to effectively manage the business, to reduce costs, maximize profit, maximize sales, right? The all this information, of course, is created using accountants to some degree. There are all different types of accounting levels and different types of accountants that you may not have thought about before. These include people like data analysts, uh, audit associates, general accountants, controllers, CFOs, treasurers. All of these people work in accounting, right? In some way, shape, or form. So it's just important to know that these people are here and what they do. These people also earn certifications. So, for example, just recently, I sat for an exam. The exam was called the Certified Financial Management Accounting Associate. Certified Financial Management Accounting Associate. It's a certification, it's a professional certification. I recently sat for the exam and I passed it. I was actually kind of shocked I passed it because it's a very difficult exam, but I passed it. And what that exam does, or that certification does, is it says that I'm a certified expert in financial and managerial accounting. There are other professional certifications out there that people interested in accounting can earn, and this also, of course, helps with their careers later on down the road. One of those is called a certified management accountant. We also have certified global management accountant, of course, the CPA, certified public accountant, the CFM, certified financial manager, certified internal auditor, certified bookkeeper, certified payroll professional, which a lot of HR people typically go after, certified fraud examiner, and certified forensic accountant. So, just to name a few. But those are professionally recognized certificates within the industry, and these people play key roles in all businesses. So, it's just important to understand what these certifications are and that they are available to even us as financial and managerial accounting students. Of course, with the advent of artificial intelligence, we understand that AI is here to stay. It's embedded in pretty much every aspect of our daily lives. It is also very important in all of our work life as well. You probably use it on a daily basis and don't even realize it. If you've ever written an email recently, you've used AI. If you have um, used Excel recently, there's a good chance you've used AI. ChatGPT, you used AI. You know, Copilot, you used AI, right? It's embedded in everything we do. Take out your cell phone, do a search. Guess what? The first thing that you see is AI results. Okay. Do any type of search on any search engine. The first thing you see are AI driven results. So it's not just an industry, it's something that's embedded in all industries, and especially in accounting. We use AI to help us to reduce repetitive tasks like entering transactions, preparing financial statements like the income statement, balance sheet, statement of cash flow, statement of retained earnings. AI helps us to analyze and interpret the data, and it gives us recommendations on what to do in the future. So it's embedded in all of our decision making processes today, and it will continue to be it well into the future. So don't you ever think that AI is going away, because it is considered to be the seventh industrial revolution of our life. Along with artificial intelligence comes data analytics. Data analytics, of course, has been around for a lot longer than artificial intelligence has, but artificial intelligence helps to drive data analytics even further. The idea here is that we're able to visualize data to help our employees and managers to make better decisions. We can visualize the income statement, balance sheet, statement of cash flow, statement of retained earnings in a more meaningful way where managers can make more effective decisions based off of trends. We visualize the trends and therefore can make better decisions based on those trends. There's four areas of data analytics that you should be aware of. The first is called descriptive analytics. And what this does is it summarizes and describes events from the past. Descriptive analytics describes events from the past. We also have diagnostic analytics. This reveals causes of events from the past. Diagnostics, right? Your doctor uses diagnostic analytics on your results based off of your blood tests and various physical exams that you go through. They use diagnostic analytics to help diagnose you, right? Your situations. And then they provide what we call predictive analytics. They predict what might happen in the future to you based off of those results, right? So this isn't just accounting. This relates to every facet of all industries. And we also have prescriptive analytics. This creates action plans to achieve the desired future results. Prescriptive. It's like the doctor prescribed you some medication to achieve a desired future result, which is lower blood pressure or lower sugar levels or whatever, whatever that medication was for. But you understand where we're going from. There's also a fifth type of data analytics, and we call this cognitive analytics. This is where artificial intelligence, machine learning come into play, and they actually understand data in a way that mimics human cognition. We call this cognitive analytics. The idea here is that we extract the knowledge based off the data in a way that humans can understand it. With that data and with the data comes data visualization. We can create charts and graphs and ways to explain data to help managers to make informed decisions. We use a lot of popular software to do this, like Tableau and Power BI. I personally like Power BI a little bit more than Tableau because Power BI is free to use. Tableau requires a subscription. Power BI is a part of Microsoft tools, so I always recommend Power BI over Tableau. These softwares help us to create what we call data dashboards. The dashboards are ways that we can visualize different charts and graphs that help us to understand different areas of the business. So, for example, in accounting, I use a dashboard to help me to understand my revenue trends, my expenses, uh, the different people that I owe money to and their amounts, all within one dashboard. Just right there on a home page, and it's all organized for me. I can click on one of those parts of the dashboard and zoom in to get more detail. So that's what Power BI does for me. It helps to visualize my data all in one place. So does QuickBooks. QuickBooks has a similar function. Okay, so that's data visualization. Now I want to get into the real foundation of this course, which is helping you as a manager to understand the cost of doing business, which is categorized in different ways. I want you to get into the mindset of a manufacturer. We are making a product. I have a water bottle in my hand. This water bottle is a very simple bottle. It's from Costco. It's a Kirkland water. It's very simple, just like any water bottle you've ever bought. It costs very inexpensive, maybe $1 at the grocery store, right? $1 for a bottle of water. It's simple. It's made of plastic. It has a plastic cap. It's 12 ounces of fluid, and it has a label on it. That's it. It's a real simple product. But there are costs associated with making this bottle of water. There is the cost of the plastic. There's the cost of the water, the cost of making the label, the cost of producing the actual bottle. There's some direct materials, direct labor, some factory overhead. These are all the costs that go into making this bottle of water. I want you to understand that because as a manager, you need to be able to control your costs. So there are two ways that we can classify our costs. One is called direct cost, and the other is called indirect costs. And the names kind of help to summarize exactly what it is that we're talking about. Direct costs are costs that I can directly trace to the finished product. Direct costs are costs that I can directly trace to the cost of the finished product. These include direct materials and direct labor. Direct materials are the materials that make up the majority of the cost of making the product. Direct materials make up the majority of the cost of making the product. Okay? Direct materials. For example, for making a bottle of water, the direct materials involved here are plastic. Plastic makes up the majority of the cost of making the bottle of water. Then, of course, the water itself is also direct materials. We also have indirect costs. These are costs that I cannot easily directly trace to the cost of the product. Okay? Indirect materials involve things like indirect materials and indirect labor. Direct costs are direct materials and direct labor. Direct materials make up the majority of the cost of making the product, and direct labor is the employees directly working on making the product. Direct labor. That's the hourly rate times the amount of time that the employees are working on making the product. Direct labor. They're directly involved in the process. Indirect costs are costs I cannot easily trace to making the product. These include Indirect materials like lubricant or glue that hold the cap together on the bottle of water. That's very insignificant cost. So minuscule you barely even know it's on the bottle itself, right? Makes up a very, very small amount of the product. It's just a little bit of adhesive. That's indirect materials. We also have indirect labor. Indirect labor are the salaries of the supervisors, salary of the manufacturing supervisor. I cannot directly trace the supervisor's salary to making the bottles of water because the supervisor is not hands on. They're just observing the employees that are actually doing the work. Supervisor supervises the direct labor. So, therefore, the supervisor's salary is an indirect labor cost. So, here on the bottom of the slide, we see examples of direct cost and indirect cost for manufacturing a bicycle, for example. Direct costs of making a bicycle include things like the tires, the frames, the seats, the chains, the handlebars, the brakes, the cables, the pedals, the spokes, the rims, right? Those are all components to making a bicycle. They make up the direct materials costs of making the bicycle. The direct labor for the bicycle are the people making the bikes. They're directly involved in making the bicycles. For indirect costs, costs I cannot directly trace to the making of the bicycles, these would include things like the factory accounting office, the factory rent, the supervisor's salary, utilities for the factory, insurance for the factory, property taxes, equipment depreciation for the factory equipment. All these are indirect expenses, right? Can't trace them directly to a single bicycle, but I can apply them indirectly to the cost of making all the bicycles. You see, that's what makes it indirect. Diving a little bit deeper on each of these areas, direct materials, these are costs that make up the majority of making the product. I can directly trace these costs to making the product. Examples of making the bicycle include the tires, the seats, the frame, the pedals, the bikes, and the cables. They make up the majority of the cost of making a bicycle. Call those direct materials. They directly go into making the product. Direct materials. They're crucial parts of making the bicycle or the direct or the finished good, the bicycle. Direct labor. These are the employees that are directly involved in the manufacturing process. We call them direct labor. Direct labor costs are the wages and benefits of the direct labor that we can directly trace to the manufacturing process. Right? Examples of these of making the bicycle include things like the wages paid for the assembly employees, the wages paid for the people doing the welding, the painting, the forming, right, of the bicycle, the wages paid of the employees directly working in the process, that is direct labor. Also included in the manufacturing cost of making a product is what we call factory overhead. Factory overhead, as the name implies, is the all the other stuff. Factory overhead. It's the rest of everything else, as I like to say. This is factory overhead, or also known as manufacturing overhead, consists of all manufacturing costs that are not directly traced to making the product. So this does everything that does not include direct materials, direct labor. Factory overhead costs are manufacturing costs that cannot be directly traced to the finished goods. We apply these through a process to the total cost of the product. Factory overhead costs include things like indirect materials, indirect labor, and other indirect costs. Indirect labor, these are your maintenance employees, supervisor salaries. Indirect materials, these are the really small components like um, adhesives, screws, nuts, staples, the small, super small components that are in there, but they're so insignificant they make up a very small part of the product. Call those indirect materials. Then we have other indirect costs like utilities to keep the lights on in the factory, water, gas, electricity, factory rent, depreciation on the building and the equipment, factory insurance, and property taxes, just to name a few. Now, within those manufacturing costs that we just talked about, we can further categorize them or classify them as either being prime costs or conversion costs. Prime costs include the prime costs, the primary costs of making the product. This would include direct materials and direct labor. Those are the primary costs of making a product. That's why we call them prime costs. We also have what we call conversion costs. These are costs that are incurred in converting the raw materials into the finished goods. The bicycle started with raw materials. The tires, the spokes, the seat, the frame, those are all raw materials. We need to convert those raw materials into a bicycle. We're going to make a bike using those raw materials. Conversion costs are the cost of converting those raw materials into finished goods. This includes both some direct labor, because we use our employees to make the bicycles, but it also includes factory overhead costs. We do not include, you'll notice that the direct labor is included in both primary costs and conversion costs. Yeah, it's part of both. Because the direct labor is used in converting the raw materials into a finished good, as well as directly working on the product. Prime cost. So to recap, the costs that go into making a product, we have direct materials, direct labor, and factory overhead. These are the costs that make up the total cost of a product. Direct materials, it's the amount of each component, the cost of each component times the amount of each component used. That's the cost of direct materials. For direct labor, it's the amount of time each employee worked on the product times their hourly rates. That's total direct labor. And factory overhead, it's the allocation of things like rent, depreciation expense, supervisor salary, etc. We find a rate and we apply that to the product. That makes up the total cost of a product. We'll talk more about that as time goes on. So those are product costs, and then we also have what we call period costs. These are the costs associated with making the product, but they are not directly tied to the product. We call these selling, general, and administrative expenses. Selling expenses, either the expenses related to delivering the finished good to the customer. It also includes things like um, sales, employee salaries, and sales commission, right? Those are all selling expenses. Then we have general and administrative expenses. These are the expenses for support, staff, and other administrative functions. We call these period costs because we do not tie them directly to the cost of the product. They are simply expenses that we put on our income statement as expenses. They're time period costs. That's the difference between product costs and period costs. Examples of such for product costs, these are the costs of making the product. They go into making the product. We have direct costs, which are the tires, the seats, the handlebars, the cables, the frames, chains, brakes, pedals. Those are all the direct materials. Then we have the direct labor, the people actually making the bikes. Those are all direct costs. And we have indirect costs that go into making the bike, like the factory accounting expense, rent expense, manager's salary, utilities, insurance, equipment depreciation. Those go into uh, the product costs, total cost of making the product. Then we have our period costs. These are costs related to making the bikes, but we just expense them out. They're on our income statement. These include selling, general, administrative expenses. Right? Very, very straightforward. How are all these costs reported? You might be asking. So, these costs are allocated either to the balance sheet or the income statement. It depends, right, on how we categorize the costs. If the costs are product costs, our direct materials, direct labor, and factory overhead, we allocate that to our inventories on our balance sheet. For a manufacturing company, we have three types of inventory on our balance sheet. We have raw materials inventory, work in process inventory, and finished goods inventory. Those three types of inventory are found on our balance sheet. Raw materials inventory, those are the raw materials. We haven't started making the bike yet. They're just individual components. The cost of those individual components, we call those raw materials. So they sit in our raw materials inventory. Work in process inventory, we started making the bicycle, but we have not yet finished it. So therefore, the inventory is sitting in work in process. Then we have finished goods inventory. As the name implies, it's the total cost of making the product. It's finished and it's available and ready for sale. Finished goods inventory. All those inventories are on our balance sheet. If and when we sell some of that inventory, it comes off of our balance sheet and goes onto our income statement as a form of cost of goods sold. If we do not sell that inventory, it stays on our balance sheet as inventory. Then eventually, when we sell it, it moves off the balance sheet and onto the income statement as cost of goods sold. We also have our period costs. As I mentioned before, the period costs are costs that are related to the manufacturing process but are not a part of the total cost of the product. They are simply expensed out on our income statement as either selling, general, or administrative expenses. Very, very straightforward. So that is how these costs impact the financial statements. We can also use this same application of costing to other companies such as service companies or even retail companies. For a service company, like an airline, for example, The cost that we look at would be the direct labor, are the flight crew and the flight attendants, and the direct materials, which would be things like the food and the fuel. We also have the factory overhead for a service company that would, for an airline, that would include things like the manager of the flight crew and the landing fees for specific flights. Those would be more overhead. So the point is that we can classify direct materials, direct labor, and factory overhead to service companies as well. The primary differences that you'll find between manufacturer and a retailer and a service company is how they address inventory. Service companies don't have inventory. They provide a service. They're not selling a physical product. A retailer, yeah, they're selling a physical product. Okay, so they're going to have merchandise inventory. For a manufacturer, they're going to have the three different types of inventory I mentioned earlier: raw materials, work in process, and finished goods inventory. I'm going to talk about those again. So here we have the definitions. Raw materials inventory, these are again the raw materials, the components that we've purchased but have not yet put into the manufacturing process. Call those raw materials inventory. Then we have work in process inventory. These are the raw materials that we've started to work on, plus we add in the cost of direct labor, and we also partially apply overhead. These represent partially completed units because we're still working on them. We're working on converting them into finished goods. Work in process inventory. So it's the direct materials plus direct labor plus some factory overhead. We apply these to partially completed units. That's work in process. And then we have finished goods inventory. These are the products that are completed. We've manufactured them. They're ready and available for sale. These are the bicycles that are done. They're ready to go. They're up for sale in the store. So the finished goods inventory includes the direct materials, direct labor, and factory overhead for the products that we've already completed and are available and ready for sale. As I had mentioned, the primary differences between a service company, a retailer, and a manufacturing company is how we address inventory. Service companies do not carry inventory. Sure, they have supplies, but they're just expenses. Uh, we have a retailer. The retailer has what we call merchandise inventory. It's the merchandise that the company has available for sale. Merchandise inventory. And for a manufacturer, we have the raw materials, work in process, and finished goods inventory. So just wanted you to have an understanding of the difference between the three types of companies, because we need to be able to understand how these different companies value their inventory, how we track them, inventory, and how we cost that inventory. Now, as you know, when we sell inventory, it comes off of our balance sheet and goes on to our income statement as what we call cost of goods sold. Cost of goods sold represents the cost of the inventory that we sold. Cost of goods sold. For a retailer, it's very simple. It represents the merchandise inventory cost that they sold. Okay. For a retailer, we take the cost of goods that we purchased, we add that to the beginning inventory. So we take beginning balance inventory plus our purchases of inventory minus our ending balance inventory equals our cost of goods sold. So if you ever run into a question where the question says, hey, calculate the cost of goods sold, we take beginning balance plus purchases minus ending balance. That equals the cost of goods sold for a retailer. For a manufacturer, it's a very similar process. We take beginning finished goods inventory plus the cost of goods manufactured minus our ending finished goods inventory. That equals cost of goods sold for a manufacturing company. And if service companies don't have inventory, so you don't have to worry about cost of goods sold. Just revenue minus sales for a service company. When we talk about the cost of manufacturing, I want you to think about the physical flow. Think about an assembly line. Think about a factory and how it all works. Everything starts as raw materials. It comes out of raw materials and goes into work in process. And when we're done building the bicycle or the product, it comes out of work in process and goes into finished goods inventory. That's the physical flow of things. That physical flow helps us to understand the flow of the cost related to making that product. It starts out as raw materials inventory. That is my wheels, the spokes, the bicycle seats, the bicycle frames, raw materials. Starts as raw materials inventory. I purchase my raw materials inventory from my vendors, my distributors. They provide the company with the raw materials. We then take those raw materials out of raw materials and put them into work in process inventory. Within work in process, we add in the direct materials, the direct labor, the factory overhead. And then when we're done making the bicycle, putting it together, it becomes finished goods inventory where it's available and ready for sale. The costs move with the bicycle throughout the process. Individual component costs, raw materials. Work in process costs, putting the bike together, direct materials, direct labor, factory overhead. And it moves with the total cost of that bicycle into finished goods inventory. Right? That's the physical flow. If the inventory remains unsold, it's on our balance sheet. When we sell it, it becomes cost of goods sold. Follow the flow. Follow the physical flow of things. That helps you to understand the cost of manufacturing. I had earlier mentioned that for the inventory, to understand cost of goods sold for a manufacturing company, it's the beginning balance of finished goods inventory plus the cost of goods manufactured minus the ending finished goods inventory equals the cost of goods sold. That one part said cost of goods manufactured. I want you to be able to understand what that is. It's the cost of manufacturing the goods, the finished goods. There is a formula that I want you to know to be able to calculate the cost of goods manufactured. And that formula goes like this. We take the direct materials that we used in the manufacturing process, plus the direct labor that we used, plus the factory overhead. That equals the total manufacturing costs. We then add in the beginning work in process inventory and subtract out the ending work in process inventory. And that will give us the cost of goods manufactured. So, very important that you know this formula because I can assure you that you might have a question that'll say calculate the cost of goods manufactured. So we have to be able to calculate cost of goods manufactured using this formula. The formula does not change, very straightforward. In business, oftentimes the management wants to see a report, especially if manufacturing business. They want to see this report called the Schedule of the Cost of Goods Manufactured. Basically, what it is it shows us a breakdown of all those individual costs, the direct materials cost, direct labor cost, factory overhead cost, to get us to cost of goods manufactured. And it's computed like this. So to compute the direct materials used, we take raw materials, beginning inventory, plus purchases, uh, to get us to raw materials available for use, minus ending raw materials inventory equals direct materials used. Then we just add in direct labor. Then we compute the factory overhead. To compute factory overhead, it's very easy. We just take the direct labor plus all of our other various expenses like factory utilities, repairs and maintenance, property tax, depreciation expense, add those all up to get to total factory overhead. We add up our direct materials used plus direct labor plus total factory overhead to get to total manufacturing costs. Then we add in beginning work in process inventory to get total cost of work in process. And we subtract out ending work in process inventory balance to equal cost of goods manufactured. So again, that formula will probably come up at some point again in the future. So just be aware of how we compute it. You don't need to memorize it. I just want you to know it. You know, at least know where to find it. To calculate the scheduled cost of goods manufactured, we take total manufacturing cost, which is direct materials plus direct labor plus factory overhead. We add in beginning work in process inventory, subtract out ending work in process inventory to get total cost of goods manufactured. This is just the same thing again, just in a simpler format. That amount, that cost of goods manufactured, shows up on our income statement within cost of goods sold, right? Uh, and then it's also translated from our finished goods inventory, right? So this kind of shows you how the income statement and balance sheet are connected through the cost of goods manufactured. So that's our discussion on cost today. I'm just also going to very quickly touch on a couple of key areas that we have going on in accounting now, just so you have a pretty good understanding of what's all involved. So one of the things I want to talk about were the trends that we have in accounting that we got going on. There's a whole bunch of them. We're focusing a lot on digital manufacturing. We're involving a lot of AI and machine learning in the manufacturing process through this what we call digital manufacturing. So we're taking out a lot of the human element here, and we're relying a lot on data analytics and visualization to help us to become better at manufacturing products. This takes a lot of error out of the manufacturing process. We also look at things like customer orientation. Managers and employees, we need to understand the changing needs and wants of our customer to align our operations of the business more in alignment with our customer. We in accounting, we also look at the global economy. We don't really have borders anymore because we have this thing called the internet, and we're able to purchase and sell across borders very easily. Call that a global economy. E-commerce is probably, in a more of a mature stage now. E-commerce is simply the purchase and sale of things over the internet. You could purchase and sell things through your phone, through text messaging, and other electronic applications. We also know that especially here in the US, we've become a very service economy driven country. Businesses that provide mostly services like telecommunications, healthcare, energy, etc. They're service-based companies, so there's a lot of interest there. We also try to employ what we call lean accounting principles. The idea here is that we try to eliminate waste wherever possible. We make it lean, right? We eliminate waste wherever possible. I try to provide a positive return to the company and to the customer. And then lastly, we also look at this thing called value chain, where we add value at every step of the process. So with lean principles, again, the idea here is that we're trying to eliminate waste wherever possible. That's what this tells us. We do this through what we call just-in-time manufacturing and total quality management to ensure that what we're producing and providing to customers is of good quality and does not waste cost by sitting in inventory. Total quality management focuses on the quality improvement for the business activities. Managers and employees try to make sure that we uncover any waste, eliminate that waste, and try our best to be efficient in running the business. Just-in-time manufacturing is a process that was invented by a company called Toyota. Toyota, as you know, manufactures vehicles. They're the largest auto manufacturer in the world. They invented this process called just-in-time manufacturing. And the way that it works is everything's demand-based. So the customer places an order for a vehicle to be made. It goes into the production schedule within the factory. The factory receives the raw materials just in time to make the vehicle. The vehicle is put into assembly just in time to receive those raw materials. And then the customer receives the finished vehicle just in time as they demanded, right? So that is the concept of just-in-time manufacturing. Eliminates a lot of waste. We also look at things like the value chain. Value chain is where we add value to the product at every step of the process, from start to finish, and then customer follow-up at the end. It's important that it's not only in accounting but also in management that we focus on the triple bottom line, which is profits, people, and the planet. We need to do right by all three of these. Yes, a company needs to be able to operate fiscally responsibly. Yes, we need to be able to give back to our local society and sustain our employees. And yes, we need to do right by the environment by making sure that we limit our waste being produced. Very common thing that's being looked at here in the United States. I've also published papers on this in various publications, and I did a huge research study in South America on this topic, and it's called Environmental Social Governance. This is a framework that provides companies with the ability to be more sustainable in the future. It's not just focusing on the environment, but also includes how these companies are interacting on a social aspect and is acting with good corporate governance. So we look at environmental social governance to sustain business operations into the future. Right now in Europe, this is a required reporting mechanism for publicly traded companies. Here in the United States, it's not currently required. It is voluntary. But in my opinion, I think in the next 10 years, I think that this will be a mandatory reporting thing. So, uh, as managers, as you continue to manage your business well into the future, this might be something you might need to look at in the future. Uh, and of course, as managers, one way we effectively manage our business that we talked about in the very first week of this course is through ratios. And one of those ratios that we look at in management, especially as we effectively manage all of our various inventories, is the raw materials inventory turnover ratio. And what this does is it helps management to get an insight as to how effective we are at using our raw materials inventory. And the way that we calculate this is we take our beginning balance raw materials inventory plus ending balance raw materials inventory divided by 2 to get the average raw materials inventory. We take the raw materials used in the manufacturing process and we divide that by the average raw materials inventory to get the raw materials inventory turnover ratio. We also look at this applied through the days sales in raw materials inventory. It tells me how long our raw materials inventory is sitting on our shelves before we use it in production. And to find that ratio, we take ending raw materials inventory balance divided by raw materials used times 365 days. Again, these are efficiency ratios. As a manager, it's important that we are efficient in using all of our resources, including things like raw materials inventory. And with that, my friends, we've reached the end of our discussion on, I guess you would call this the foundations of managerial accounting concepts. Important discussion because throughout the next 12 weeks, we will be focusing very heavily on these cost concepts. So I want you to really, really understand this because this is the foundation that we will build on over the next 12 weeks. So for this Sunday night, one of the things that you have to do for me is to complete the Chapter 3 quiz related to the discussion, I'm sorry, Chapter 18 quiz that we just had related to the discussion on managerial accounting concepts. That is due Sunday night. I would like you to use the time on Thursday to please complete that quiz. Because we do not meet this coming Thursday, I want you to use the class time to complete that quiz. That'll help to alleviate stress from you so that we don't feel overwhelmed on Sunday night. All right. So, are there any comments, questions, concerns about anything that we talked about this evening or anything at all related to the class? Wow. You're all so quiet tonight. Really? Okay. So, uh, again, appreciate your time.
I'm so
Please.
sorry. I'm sorry.
No, you're good. I got you.
I have a question.
Yeah, please.
So when it comes to sales commission and period cost, why is that not considered a part of wages and salaries, as opposed to, the expense, of the period cost?
Awesome. I'm so glad you asked that question. That is a great question. So the reason why we separate something like commissions out from regular wages is because commissions are paid to sales employees based off of the amount of inventory that they sell. Typically, it's expressed as a percentage of their total sales. It might be something like 2%, 3%, 5%, whatever that percentage is. The reason why it's separated out is because when it comes to salaries, that's typically the employees that we pay annually at a fixed rate. And for commissions, that's typically based off of a percentage of their total sales that they've made. And so the reason why we separate that out as managers is it helps us to effectively manage how much we're paying our sales employees. That's an awesome question. I'm really glad that you asked that one. But yeah, that's the reason why we express that out separately. And the reason why they're classified as period costs rather than product costs is because it's related to the product, but it is indirect and it is also not a part of making the product. That's why we call it a period cost rather than a product cost.
Thank you so much. Thank you.
You're very welcome. That's an excellent question. I appreciate you asking that. Are there any other comments, questions, concerns, anything I can help to clarify for you? Any of you at this time?
I just want to say thank you for you taking your time to making the chat GBT for us.
Yes, thank you so much for noticing that. I really appreciate that. I hope that you use it. The whole idea behind this was I wanted to provide you with an opportunity to receive some tutoring if you ever need it for this course. I know that it's difficult for you as adult learners because you're juggling family, you're juggling work, you're juggling school. It's a pain in the butt to juggle all of those things at the same time. And sometimes you just need a little extra help. And so I created this GPT model to be able to help you in an effective way. So again, it's there in the classroom. It's just below. They ask the instructor, and you can ask it anything related to principles of accounting 2, and it'll answer those questions for you. It'll guide you through the steps, the processes. It does a great job at even creating charts and graphs. So if you're like, hey, can you show me this visually? It'll do it. So uh, it took me a long time to create this, but again, I wanted to do something for you. In addition to my lectures, which I hope you find helpful, this is something to supplement your learning of this content. So I thank you so much for saying that. I really appreciate that. Awesome. Any other comments, questions, or concerns before I let you all go? Great. Thank you all so very much for your time. I really do appreciate all the efforts you're making in this class. Please keep up the good work. I'm so proud of all of you and your efforts that you're making so far. Don't stop the momentum now. Just keep rocking and rolling. So thank you all so much. I appreciate all of you. Have an awesome rest of your night.
Thank
Thank
you.
you. Good
Hey,
night.
Dr. D, I have a question.
Yes, please.
Um, I came in 3 minutes late.
Okay.
Was the roll already taken?
It was. I will be happy to make that adjustment for you.
Okay, thank you so much. I
You're
was
so
trying
welcome.
to set up my Wi-Fi and everything.
I get it. It's it's always a challenge, as they say. I
Can you check for me too, Professor?
got you.
Over.
All right.
Thank
Thank you, Professor.
I got you. You're so welcome. Again, if you need anything, just feel free to reach out to me. I'm here for you, okay?
Thank
Okay.
you.
You're very welcome. Take care, y'all.
you.
Okay.
All right, bye-bye.
Black